And welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Humboldt and Clear Lake, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? I hope you're doing well, taking a little bit of time for yourself. I certainly want to say welcome to today's program. Today we're going to be discussing what appears to be a lot of market heartburn. You know, all of us can have indigestion from time to time, but gosh, it sure seems as though the market is experiencing a terrible case of indigestion. And we're going to be discussing the why and what you may want to know with regards to what's going on in the world, in the economy, and right here in our own stock market. Now, before we begin, I want to encourage each and every one of you. This radio show is absolutely powered by your questions, your concerns, your topics, the things that concern you. If you're getting closer to retirement, and if you've been a listener of this radio show or watching the podcast on YouTube or on our website, you know that this is all about how you can safeguard your money, make your money safer, and not only that, but increase 2 to 3 times the output of income, and to do it safely. Well, the reality is that this is something that so many of you are a bit bashful. You've got questions, you've got concerns, but you really don't want to ask, or you don't know how to ask. And I encourage you, if you'll simply go to our website, Johnson, W-I-M, stands for wealthincomemanagement.com. There is a box that you can submit a question to this radio show. You can also watch all of the previous YouTube videos and listen to the podcast. You can read all of the various different white papers. That website is created to help you become more informed so that you can have the retirement that you deserve. You take your retirement from where it is today to where you want it to be. And so even if you're still 5 years away from retirement, it's a good time to begin implementing and getting ready for that transitory time frame in which you're going to be graduating and going from a paycheck to a playcheck. And that's what we all want. We want to make that transition as smooth as is possible. I also encourage you, go take a look at my book, The Capitalized Retirement. It's something that is available on all the major book resellers. And The Capitalized Retirement was written with you in mind. You don't have to have a PhD. It's absolutely simple. It's plain English, and it helps you understand how you can take and really do the 2 things that are so vital to never running out of money: reducing risk and not increasing the output of real income through interest and dividends off from your portfolio, what you've worked so hard for. And so I encourage you, get a copy of that book, and when you're done reading it, read it again, and then pass it off to a friend that you know could use that same help. So let me take you back in time to the 1990s, maybe the early 2000s, maybe. Do you remember the old Tums commercials where Mr. Tums would wake up in the middle of the night and he would sit up in bed and he would belch, and all of a sudden all these flames came out of his mouth? You remember that? I always found those commercials to be very entertaining. Well, the reality is that kind of feels that same way with the stock market right now. We had a boost of optimism after the election time, and even into Thanksgiving and coming into December, getting ready for Christmas. While the market was doing well, we had earnings coming out and everything looked so very optimistic and good. And all of a sudden, now it feels as though the stock market has put the brakes on. The market is beginning to falter a little bit. It's starting to stumble. And all of a sudden, we see parentheses around our brokerage accounts and our brokerage account statements and balances. What in the world is going on? Well, as with so many of these things, it's not simply just one thing. And so I want to be able to take some time today to maybe explain the various variables, shall we call it, that are at play. And there's not one in particular that I think is absolutely it. I think that it's a combination of so many different things all at one time. So let's take a look. shall we, at all of this. The first thing that we need to keep in mind is the growth. When you take a look at the S&P 500, obviously the Fortune 500 index has done extremely well. You know, it ended the year up 24%. That's pretty strong, right? You look at indexes like the NASDAQ, it went even higher. And most of the growth that we see taking place right now in the stock market kind of circles back to the Magnificent Seven. It circles back to technology. And that's one of the concerns that I have. Because if you think about the majority of the growth of the S&P has seen, and you really do your data, what you begin to realize is that the vast majority, about 2/3 of the growth that has been taking place within the S&P 500 has been coming as a result of the growth of a handful of companies, technological companies. Now, that is exciting in many respects because we see technology, taking us to places that we never thought were imaginable. It's like we're living in a modern day Jetsons cartoon. But in many respects, we also need to go back in time. We need to be thinking about what happened in the mid-1990s. And so for those of you that may have forgotten, we want to remember in the mid-1990s, we saw this thing called the advent of the internet that took place, and the market seemed to go to the moon. It seemed as though the market was never, ever going to come down. And yet we know that the market did come down. We know that when the dot-com bubble occurred in 2000, it took the S&P 500 with it. And the S&P 500 consequently lost 50%. Now, I know that investors are not stupid individuals. You're not dumb. I'm not dumb. There's a lot of smart investors in the world. But we also need to be thinking that there is this degree of FOMO, and I've discussed this before, where when you see a lot of irrational exuberance, when you see a lot of people jumping up and down with their pom-poms, it's easy to get caught up in the hype. It's easy to get caught up with the crowd that wants to continue to go in a particular direction. Well, I also want to be that word of caution, because here's the thing. Where we've had unfettered ideas of growth and the stock market going to the moon, now all of a sudden I believe that it's starting to dawn on people what the impact of tariffs may end up resulting in being. Not only to our country, but also to our stock market. Because you see, let's think about it in very basic terms. When we're in the stock market, when we're investing in mutual funds and index funds, what are we buying? Well, essentially, we're buying the stock of companies. And if all of a sudden we're going to experience these full-grown tariffs that are taking place or that are being threatened to take place, number one, we know for fact that that's probably going to have an impact on many of the corporations here in America. Many corporations today, as you well know, are relying upon other countries to source their ingredients or their parts or the materials for their parts, for the things that they create. And we know that if the cost of those goods and services goes up dramatically, that's going to have an impact on the profitability of the corporation. Now, it doesn't necessarily mean that those companies can't jack their prices up and pass those price increases on to us, because we know that they do it. We know that they've done it ever since the times of COVID. We know that during the supply chain shortage, many corporations raised their prices much, much higher simply to pass on the price increase that they were paying. But you see, what's creating a lot of the volatility right now is simply the uncertainty. No one knows how far or what the ramifications of these tariffs are going to be. Is this going to be full-blown tariffs? Is it going to be on every single country? Is it only going to be on the countries that we don't really like? What is the extent of this? How long is this pain likely to last? You know, I have to tell you, I was watching an interview of Trump, and someone asked him in the crowd, one of the press or one of the journalists asked him, well, what's the side effect to the stock market going to be? And he kind of shrugged his shoulders. That's about all he responded with. And if that doesn't kind of scare you a little bit, I don't know what does. Now, that doesn't mean that I'm not optimistic for good times ahead. I think that there could be many, many good things with this administration, as there has been good things with many other administrations. But the reality is that the market's starting to think about the implications of these tariffs and what it may end up doing to stock prices as a result. And so now all of a sudden the market's starting to backtrack just a little bit. It's starting to think about the end result and what that end result may be. And so if we're looking at our portfolio and we've seen this big run of, say, 20 or 24%, can you really blame the investors for taking and starting to pull their winnings off the table? Let me ask you, are you pulling winnings off the table, or are you continuing to sit there and play your poker chips? You see, there is a lot at risk here. And it's not just money, ladies and gentlemen. It's also the risk of your time. Anytime you're hiring a financial advisor or you're hiring a financial institution to invest your money, just remember, it's not just money that's on the table. It's also your time. Because if you lose too much, now all of a sudden, you're left waiting. You're waiting for things to recover before you feel good about spending money again. And it's interesting, we don't have to go back too far in history just to figure out what that time is. Of course, I could take you back to 2000, showing you that the market didn't recover fully until 2007. I can show you a big drastic dip like that, a big V. I can take you back to 2007, 8, and 9, not recovering fully until 2013. I can show you that one. But we could go back to simply January of 2022 to January of 2024, 2 years of a dip in which there was absolutely nothing. And so I have to ask you, if you're closer to retirement and all of a sudden the market is sitting at an all-time high and the market begins to decline and you're about to retire, what do you think that may mean for your mindset? What do you think that may mean for your retirement, for those trips that you have planned? This is just questions that I'm asking that you can think through your own set of ramifications. Sit tight. We're going to be right back talking about the next headwind that is facing the market right now. And it's a big one. You're not going to want to miss it. Sit tight. We'll be right back. And welcome back to the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Humboldt and Clear Lake, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? If you're just joining us, welcome to the program. In the first half, we started out the program taking and reminiscing about the old Tums commercials, where Mr. Tums would sit up in the middle of the night in his bed and he'd belch, and all of a sudden the flames had come flying out of his mouth. It was so iconic to think about heartburn, right? Today we call it any number of different things, but back in the day we just called it heartburn. And it seems as though the stock market has got a bad case of indigestion. It's got a bad case of heartburn. So in the first half of our program, if you're just joining us, we discussed how we're seeing all of this optimism starting to wane because we don't exactly know what the outcome of these tariffs are going to be. We know that we're getting closer to Inauguration Day. And so what is the end result? How extensive are these tariffs going to be? What's it going to do to the profitability of the companies and the corporations that I'm buying stock in? These are all very good questions to ask. And yet there's really no good answers because we don't know yet. But as I indicated before the break, there's also a second thing that's a bit of a headwind to the market right now, and that is the uncertainty of the Federal Reserve. You see, the uncertainty is not only being felt by you as an investor that's getting ready to retire, but the uncertainty is really being felt by the Federal Reserve. So let's just kind of go back in time and just think about what's happened. So the Federal Reserve They see the great pandemic. We send everybody home. We shut the world down. And now we got to get the economy moving again. So what do? Well, we take interest rates. We drop those rates to zero because that's going to stimulate spending, right? That's great. But the reality is that if you leave that going on too long and you leave those interest rates too low, you're going to end up seeing not only the market explode, you're not only going to see the growth within the country explode and you're going to see the economy expand very rapidly, but you're also going to be experiencing this little nagging thing called inflation. And so inflation gets up near 10%. The Federal Reserve jumps on the bandwagon and says, no. We've got to stop that. And what do they begin implementing in February of 2022? They started implementing rate increases. They started driving interest rates up to make borrowing money more expensive, because if you make borrowing money more expensive, well, guess what? You're not going to buy the new car. You're not going to build the new home. You're not going to expand your business. It's going to slow down because it makes borrowing money more painful. And so the Federal Reserve finally gets inflation down to what I would refer to as what they consider an acceptable level. Remember, their goal was 2% inflation, right? And right now it's sitting at about 2.7%. But they're looking at their data, and the latest thing that just came out was the jobs report. And all of a sudden, we're thinking we're going to have 150,000. And all of a sudden, we see 250,000 new jobs. Boy, that's an indication of economic growth, right? And they want to see growth, but they don't want to see a lot of growth. They want to be able to see a muted economic set of data coming out. And then all of a sudden, you look at the message, you look at the agenda, you look at the policies that Trump is talking about, which I think, as most Americans, you kind of agree with. You want to see a flourishing economy. You want to see growth within the stock market. And all of a sudden, the Federal Reserve is getting extremely nervous. They're wetting their pants right now because they are afraid if he continues to focus on growing the economy, getting a strong economy, getting profitability and expansion, well, guess what? That's probably going to spike inflation. And as a result, the Federal Reserve is already starting to change their policy. You know, where 2024 ended with the expectation of all of us that we would be seeing maybe 2 to 3, maybe even 4 rate cuts from the Federal Reserve, depending upon what the economy did and how the election turned out. Now the Federal Reserve is looking us in the eye, and they're saying the opposite. They're saying if they even give us 1 rate cut this year, we better be considering it a gift. And so what does that mean? It means that interest rates are going to continue to stay fairly high. Now, this is not only affecting the common stock market because of the tariffs and the interest rates probably remaining higher than expected. Well, and that drives up costs for companies in both respects, not only in what they have to pay for the products, but also for what they have to pay to borrow money, because a lot of corporations across America have already taken and burned through a lot of the cash that they had to get them through these tough times. But now all of a sudden, we see that it's affecting the bond market, right? We're seeing where we're looking at the 10-year Treasury, which, thank goodness, now we have no longer an inverted yield curve. Now we actually have the 2-year and the 10-year and the 30-year, and the longer the time frame, the higher the return. But people are getting nervous. Investors are getting nervous. The market's getting nervous, seeing the 10-year Treasury go from 4.6 to 4.8. And they're wondering, is the 10-year Treasury going to go to 5%? Why is this? Because all of a sudden, now it creates an incentive for investors to flee to safety. And you see, this is another deterrent. This is something where smart investors are always paying attention to what they're paying. They're paying attention to what's happening in the future. Is there going to be something on the horizon that's going to potentially jeopardize the profitability or the stock price that they own? And as a result, they're starting to become a little skittish. They're starting to pull back. I'm going to give you an example, and did something a little more extensive in a previous broadcast, but I can't end today's program without discussing even price to earnings ratios. Now, we're not going to get very deep into this. This is something that I encourage you to go to johnsonwim.com and listen to the broadcast on price to earnings ratios and why they matter. But let's just think of a price to earning, a PE ratio, as a way to find to understand something that's extremely mind-boggling in a very simple way. In other words, if you think about where the market is at today, just as a broad market index, if you look up like Shiller PE ratios, you're going to understand that as of right now, in January of 2025, we have a PE ratio of 36.98. Now, that doesn't mean anything to you if you're not familiar with PE ratios, but let me put it to you this way. Let's say that there was an ice cream parlor and you want to buy the ice cream parlor, and this ice cream parlor makes $100,000 a year in profit. Let me ask you, would you ever dream of paying $3.7 million for that ice cream parlor? And the answer is probably not. Well, you see, the reason the PE ratios are so important to pay attention to, and if you're working with an advisor, you're working with an institution, and you want to hold them accountable, you want to be paying very careful attention that they're not overpaying, that they're not using your money to buy things that are extremely overpriced, okay? You would never dream of buying an ice cream parlor for $3.7 million, right? Because, well, number one, you'll have to wait 37 years to get your money back. And number two, well, gosh, do you really want to be scooping ice cream to make $100,000 having paid $3.7 million for this business? And the answer is no. And yet that's what investors are doing right now. And so if enough investors start to begin to wake up to the reality that the market is overpriced, the stocks are overpriced, and they're seeing that they can put their money into, say, government bonds that are paying them 4.8, 5%, who knows what that interest rate is going to be, can you blame them for taking their winnings off the table? And so how does this affect you? Why does this affect you? Well, before bad times occur, before stock market crashes occur, we can sometimes find the PE ratios get extremely high. They get into the high 30s. They get into sometimes as much as the low 40s before that really bad time occurs. And so this is kind of that precautionary tale. This is the smoke alarm that's going off, that's letting you know that something is wrong. And the question is, are you going to pay attention to it? See, the market is responding, and the problem with this is that so many advisors today are convincing their clients to continue to stay in. They're continuing to convince the client that the sky's the limit, it's going to go to the moon, it's going to be different this time, when in reality, we simply need to be exercising prudence. We've had a good run, and now it's time to take some winnings off the table. You know, let's not get greedy, because we remember the old adage, pigs get fed, but hogs get slaughtered. I know it's very uncouth, it's almost rude and crude, but that cliche phrase exists for a reason within the stock market. So my question is, are you paying attention to the heartburn? Is it time for an antacid? Is it time for you to take some of your winnings off the table, become more conservative, and start working with a fiduciary, one that's going to help transition you in a place where you can capitalize upon all the growth that principal has seen, and now do two things that are of particular importance to you. Number one, make that principal safe, and number two, get that principal to maximize the output of income. Producing 4, 5, 6, or more % a year in interest and dividends, because here's the beautiful thing about income. Income is a bird in the hand. You can spend that income if you wish, and if you don't need it, you can use it to continue to buy. And that is so very vital for a retiree. Continue to buy shares. And if the market's declining and your income is everything you want it to be and you still have income left over, well, guess what? Now you've got the best of both worlds because you're able to buy things at a discount. So hopefully today, even though we started out with something kind of more fun, more entertaining, thinking about Mr. Tums and his big flame shooting out of his mouth in the middle of the night because of his indigestion, this is starting to give you an indication that it's time to maybe put the foot on the brake pedal instead of the gas. Remember that these numbers can indicate some tough times ahead. And I don't want to see you getting hurt as an up-and-coming retiree. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.